Welcome to This Explainer. Today, we're cutting through the jargon and breaking down the Reserve Bank of India's 2022 Master Direction on hedging commodity and freight risks in overseas markets. Look, we all know global markets are incredibly volatile right now, and understanding the precise regulatory framework you operate within, well, it's absolutely crucial for your company's financial health. So we're going to unpack exactly what the RBI expects from you. We're pulling this actionable framework directly from the official RBI circular. My goal here is to give you, whether you're a corporate treasurer, a CFO, or a financial controller, a clear, reliable playbook for managing all that global market volatility. No guesswork here, just the direct guidelines from India's central bank, translated into a structured format you can actually use right away.
Here's our roadmap for This Explainer. We'll start with Section 1, Understanding Overseas Risk Hedging. Then, Section 2, Eligible Entities and Exposures. Next is Section 3, Approved Commodities and Products. Then we hit Section 4, Key Operational Guidelines. And finally, Section 5, Guarantees and Mandatory Reporting.
All right, let's jump right into Section 1, Understanding Overseas Risk Hedging, the basics. So the RBI draws a pretty hard line in the sand regarding core concepts. The circular explicitly defines hedging is the activity of undertaking a derivative transaction to reduce an identifiable and measurable risk. Notice those two specific words, identifiable and measurable. They want to be absolutely sure you aren't out there just speculating on overseas markets, but rather actively protecting your bottom line from specific commodity price and freight risks. Moving on to Section 2, Eligible Entities and Exposures. Who and what? Simply put, the doors are open, but, not to everyone. If you're a resident corporate entity or a business operating in India, you are eligible to use this framework. Individuals, however, strictly excluded. This is a corporate risk management tool, plain and simple. Now, before you make a single trade, you have to make a really crucial distinction. Are you dealing with direct or indirect exposure? Direct exposure means you're buying or selling a commodity or a product containing it, where the price is explicitly fixed to an international benchmark. Indirect exposure, on the flip side, means you're dealing with a product that contains a commodity, but the final product's price, it's not directly linked to that international benchmark. Understanding exactly which bucket you fall into is literally the foundation of your compliance. And if your company is exposed to freight risk, well, the rules get very specific. You don't just get a blanket approval because you ship goods. You only qualify to hedge freight risk under the specific framework if you're actively engaged in the business of refining oil or in the actual business of shipping itself. The RBI keeps this one highly targeted. Okay, let's look at Section 3, Approved Commodities and Products, the tools. For direct exposure, the RBI actually gives you a surprisingly wide berth. You're permitted to hedge almost any commodity in overseas markets. But there are two major exceptions you really need to flag for your team. First, gems and precious stones, completely off the table. Second, if you need to hedge the price risk of gold, you can't just do it anywhere overseas. That's restricted strictly to the International Financial Services Center, or IFSC. However, if your exposure is indirect, meaning, again, your product price isn't pegged to an international benchmark, the RBI restricts your options strictly to these 6 base metals: aluminum, copper, lead, zinc, nickel, and tin. The RBI does review this list annually, but for now, if you're hedging indirect exposure, you absolutely must stay within these 6 metals. To actually manage these risks, you're authorized to use standard, what the RBI calls generic products in the overseas markets. This includes your standard futures and forwards, vanilla options, so both calls and puts, and swaps. These are going to be the bread and butter of your corporate hedging strategy. But what if you want to use complex, structured products, like combining cash instruments and generic products? Well, for that, you have to meet a higher threshold. Because these products inherently carry more complexity, the RBI requires you to be either publicly listed on a recognized domestic stock exchange, a fully owned subsidiary of a listed entity, or an unlisted entity with a net worth exceeding 200 crore rupees. Basically, they just want to ensure that only companies with substantial financial buffers are out there playing with structured derivatives. All right, that brings us to Section 4, Key Operational Guidelines, the how-to. The compliance journey here is pretty rigid and very sequential. It starts right at the top. Step 1 requires a comprehensive risk management policy that's been formally approved by your board of directors. Step 2 requires strict financial hygiene. You've got to route all payments and receipts related to these hedges through a designated special bank account set up purely for this purpose. And Step 3, that's your oversight mechanism. You must obtain an annual certificate from your statutory auditor explicitly confirming that your hedge transactions and margin remittances perfectly align with your actual corporate exposures.
Finally, let's wrap up with Section 5, Guarantees and Mandatory Reporting, Accountability. Now, there is an interesting operational perk tucked into the circular regarding your margin money. Rather than remitting hard cash overseas to maintain your margins, Indian banks are permitted to issue a standby letter of credit, or an SBLC, on your behalf for a maximum period of 1 year. This is a really fantastic tool to free up your immediate cash flow while still participating securely in those overseas derivative markets. But here's where the strict accountability comes in. This is a recreation of Annexure I from the circular, and it shows exactly what granular data points you and your bank have to track for the RBI. They want to see the specific commodity and then trace the money moving in and out.
You literally have to declare your exact exposure quantity.
And then map that directly against the hedges you've actually booked to prove you aren't over-leveraging. The regulator is looking at this side by side to make absolutely sure your hedges do not exceed your actual underlying business risk.
And this data doesn't just sit in a drawer somewhere. This report must be filed quarterly through the RBI's Centralized Information Management System, or CIMS portal. The deadline is strict, due by the 15th of the month following the end of the quarter. And guys, here's a massive compliance trap you have to avoid. You must file this report even if you made absolutely 0 trades that quarter. Yes, a nil report is strictly mandatory. Forgetting a nil report is one of the easiest and frankly most absurd ways to trigger an unnecessary regulatory headache. So, the crucial point to take away from this explainer is a question for you and your board to discuss at your very next meeting. Are you leaving money on the table by not properly hedging your overseas commodity and freight risks? Or, conversely, are your internal documents, bank accounts, and auditor relationships truly ready to leverage this RBI framework safely and compliantly today? The tools are laid out clearly. It's up to you to build the structure.